Hi, welcome to the Dow Market View for Thursday, the 2nd of October 2014. Starting off with the 5-minute chart. Pre-market, the Dow was very much sideways, finding support at the 17,000 area. However, things were to change when the market opened. We had some selling coming into the market. This then accelerated with 50 points straight down in the second bar there, the selling going through the 16,950 and then all the way down to the 16,900 before the market found some support. A bit more news at after 3 p.m. This was factored into the market. Prices moving lower still, down to 16,858 before the market rallied and attempted to come back above 16,900. There we see a sell signal after the market's rallied, so let's just mark this up. And we see the markets continuing to move lower there. The actual range, I'm just going to show you this first. We've got from here down to the low there, which is 113 points of available points in this trade. So the market's closed through the scalp area there, and we've traded down to the 16,850 area, which gives around 45 points from entry to this current support. You can see the market finding support here before eventually we see the selling return, and then the market trading down to the 16,800 level before it's tested and prices reverse to move back to the upside. Now, how could you have stayed in this trade for the longer term? Well, first of all, we can see the market's finding support here. So again, I keep saying this, it's amazing how the Dow does this. It will actually trade to the psychological levels. And if we just scroll back there, you can see exactly what it did in the first 10 minutes there. Traded to it, stopped, and then it continued through to the next one. And again, you see it's sort of stopping and then coming back, and again exactly the same here once the market had filled this sell signal. There are many things that you can do, and one thing I'm going to show you this morning is if you actually double up the time scale to 10 minutes and the sell signals in this area in the 5-minute chart, you can see the market moving lower, and just have a look at each of these bars as the market moves lower. What you will see, even though the market makes a high than this previous bar's high, and again here this high's higher than the previous bar's high, one thing that's not happening until we get to this point, this is the first bar to actually close above the previous bar's high. So a simple technique like that, waiting for the market to actually close above the previous bar's high, will allow you to stay in the market. And the first clue obviously is to use a larger time frame, so it takes out some of the noise that you actually see in the 5-minute. You can see there where the market's closing above the previous bar's highs, and the same there, and eventually of course down here. But in the 10-minute chart you can see how it removes the noise and allows you to stay in the trade for the longer term. The second thing, of course, is to use the 100% extension, which I've spoken about before, and there is a video on the YouTube channel that shows this as well. But the most difficult bit is this bit here, where you've got the support coming into the market. So again, you've got 40 plus points on the table around here. This could allow you to actually move the stop. Initially, we move the stop to break even once the scalp is taken out. When prices get to a psychological level, we can then move the stop from break even to the scalp area and then trail the market that way as well. So you've got to give the market a bit of room to breathe, or otherwise you will get taken out of the market. We then get the support coming into the market at the bottom here, and we see prices moving to the upside, and we've got what's known in the trade as a dead cat bounce. And what that means is that dead cats may bounce, but they don't run off. and this is a classic example of that. We've got a down move in the background. I spoke about it in yesterday's market view. The Dow is currently short. We are going to get brief rallies to the upside, but they are going to be short-lived for the time being. And here's an example of that. So the market's rallying up. It trades up towards the 20 pip scalp and then reverses, and we see the market then moving lower. We've also got a second sell signal here, but what you've got to keep in mind, two things here. First of all, the market's moved over 100 points in the background here. That's just from this signal. So if I just drag this back, and let me just remove that to get the tools. If we go from the open down to the low, you can see there 243 points. And the second thing is, we've got a situation, first of all, we've got 240 points down in the background, and we're heading towards the close of the session as well. So you can't expect the market to move down another 240 points. So this is why this one also shows a potential loss, because the market's found buying support in the previous area and reversed and come back to the other side. So if you've already made 40 or 80 points for the day, then it's best to stay away from the trade. However, conversely, if you've got a situation where you have a couple of losing trades at the beginning of the trading session, there's a good chance when the market breaks you will make that money up. But the difference is, one is greed. You've already made the money and you want to have more, which is never a good idea. You should just settle for 40 or 80 points, whatever it is that you've made on this type of trade, and walk away. And again, just to make the point that if you've had a couple of losing trades at the beginning of the trading session, there's a chance of actually making that up. And this is why you'll see signals fail towards the end of the session, because all of the activity has happened beforehand. So the market's already said to you, look, I've given you the chance to make a few quid out of the job, and if you start to get greedy, then I'm going to take it back off you. And that's precisely how the markets work. So it's a psychological game. It's a bit like any sort of poker or that sort of thing, where it's a mind game, and you've got to apply logic and common sense to it. You've been given the opportunity to have profits out of the market. Don't get greedy towards the end of the trading session. And also keep in mind that background situation in the daily chart, where we've got these lower highs, and we're just seeing the acceleration to the downside there as well. So again, watch out for the dead cat bounce as well. On in the daily chart, we can see we've got this big move to the downside. You can see the market's breaking now. We're likely to get, as I say, the odd bounce to the upside. Watch the market on the buy side at the moment, because unless there's any sort of positive news to bring this market back, then keep the stops fairly tight on the upside if you take the buy side signals in this market. Right, let's have a quick look at today's economic news. We're only interested in after 2:30 p.m. and the only thing we've got is factory orders month on month, 3 p.m. for the US, so that shouldn't have too much of an impact on the market. And finally, let's have a quick look at the implied volatility, 13.38. So the market starting to accelerate to the upside there, getting close to the previous highs in the implied volatility we saw during August there. So we'll keep an eye on this, look for 100% increase in the implied to give an indication of a potential market bottom. Right, that's it for this morning. I will see you in tomorrow's. Have a good day. As ever, thank you for your support. It is very much appreciated. And also for watching. See you in the next one.